Hello and welcome to our latest market update. Today we'll be discussing the current outlook for global energy markets and highlighting some of the key drivers to watch as we approach the winter months. UK demand ticked up during July, with temperatures sitting above seasonal norm for most of the month. Increased cooling demand, a subdued renewable picture and European gas supply concerns have narrowed the spread between day-ahead and month-ahead pricing. The demand picture for winter will mainly be driven by domestic heating demand. Whilst weather forecasting may only give us an accurate picture in terms of days, we can observe global climatic phenomena to gain insight into what the winter months could bring. Current modelling shows a 60% plus chance of a La Niña event occurring in the Northern Hemisphere during early winter. Typically, La Niña years are associated with cooler weather conditions and increased snowfall in the Northern Hemisphere. We expect market reaction to cold weather to be even more exaggerated during winter 22-23, given European supply concerns. There is potential for demand to be reduced due to high prices, but cold weather will still result in demand pressures. Beyond the usual winter stresses on the UK gas and power networks, we expect continental export demand to remain high during winter, which will add further pressure to the system. The UK gas supply picture has remained healthy in recent weeks, with continued LNG imports and strong Norwegian flows. Renewable generation has generally just been below seasonal normal levels. There is concern that LNG imports into the UK could be slowing, with no arrivals yet scheduled for August. Strong competition from European and Asian gas hubs, coupled with the ongoing outage at the US Freeport LNG facility, are likely to remain concerns going into winter. Norwegian flows are expected to fall as we reach mid-August, as the maintenance schedule picks up until the end of September. Norwegian gas remains a stable supply source for the UK, but any unplanned outages or strike action could result in significant upside during the winter months. Between 1.1 and 1.8 gigawatt of British nuclear capacity will consistently be offline for maintenance until the end of the year, adding further tightness to the winter supply picture. There's also increasing concern around the French nuclear fleet, an integral part of Europe's power supply, as over half the country's reactors remain offline for maintenance or safety reasons. European gas supply concerns remain the number one driver across UK and European markets. Russia cut Nord Stream flows to less than 40% in mid-June, citing a missing turbine that had been held in Canada following maintenance work. The turbine is now on its way back to Russia, but timescales and whether flows will increase upon its return remain uncertain. In recent days, Russia has announced that Nord Stream flows will be reduced to just 20% of capacity as another turbine undergoes maintenance work. Russian gas flows will remain a key risk factor throughout this winter. The fast-paced and uncertain nature of developments means significant risk premiums continue to be built into prices. Reduced flows, outages or negative political developments during the winter period have the potential to cause price spikes which could far exceed those seen previously. Rising global economic fears continue to mitigate upside price action from a squeezing supply picture to keep the wider commodity complex range-bound throughout July. Global oil supplies are set to remain tight, especially given concerns around OPEC's capacity to step up production. Demand is forecast to surpass pre-pandemic levels in 2023 as China continues to ramp up consumption following multiple COVID lockdowns. However, high prices, particularly on the back of the strong US dollar, coupled with global economic concerns, will continue to moderate prices. Similarly, economic concerns continue to cap demand-driven gains on carbon markets. If EU countries mandate demand reduction this winter, the economic impact on the Eurozone would be significant. However, as Europe continues to increase coal-fired power generation to reduce reliance on Russian gas, prices could remain supported despite any downside provided by a weaker Eurozone economy. Adopting a long-term flexible strategy remains the best tool to reduce the risk of purchasing at or near to market highs. Essentially, buying little and often over a large window of time spreads risk. UK wholesale energy markets remain in backwardation, so longer-term strategies also allow consumers to take advantage of these conditions. For larger energy users, this can be achieved with a flexible energy contract and comprehensive risk management strategy. For consumers who cannot access standalone flexible contracts, Trident's framework solutions provide a facility for purchasing energy flexibly with multiple strategy options for varying risk appetites. For those requiring fixed contracts, Trident would advise agreeing those contracts as soon as possible. Market conditions remain extremely volatile with very little chance of significant downside before winter. Extreme market conditions coupled with the usual September rush could mean some suppliers become incredibly stretched and some may even withdraw from pricing for periods of time as we get into September. A longer-term fixed contract may provide a slightly more competitive price due to backwardated market conditions. However, this option does require fixing during extreme market conditions for a longer period of time. That brings us to a close on this update. If you have any questions, please feel free to contact us. You can also find the latest energy market commentary from our experts on the Trident Utilities website and social media platforms. Thank you for listening.